When you enter adulthood and start making real money, it's essential to understand how to properly manage it. Making the wrong sort of financial decisions when you're in your early 20s can be so detrimental that it could potentially take you decades to recover from. In this video, we're going to cover the top 6 financial mistakes that you need to avoid when you start out in your 20s, so that way you can start building wealth right away instead of having to worry about climbing out of a hole of debt. I'm Bradford, the Pimp Instead of Personal Finance, and the first set of mistakes that we're going to talk about here all deal with the general trend of living above your means. It isn't simply enough to spend all the money that you make in your paycheck and to avoid debt. What you want to be working towards is spending less than your total amount of money that you make, so that way you can allocate some of your resources towards saving for your next vacation, and more importantly, investing for your future. Without purposefully living below your means, you're just going to be treading water and never making any sort of financial progress. Now, since the issue of living above your means is such a large, overarching problem, I've divided it up into 5 specific subsets of pitfalls that I see people fall into most often. The first one is just not having a budget. If you don't have a budget, you're not being able to properly track where your money's going, and what you're going to end up doing is you're going to reach the end of the month wondering where your money went. Now, once you have a budget in place and you've previously allocated where every single dollar is going to go before it ever even clears into your bank account, this is going to be putting you in charge of your money, so that way you are telling your money where to go instead of wondering where it went. Now, the great thing about when it comes to budgeting is we have so many resources available to us. Yes, you can still do pen and paper budgeting, you can use an Excel spreadsheet, you can build something on the website, or you can use any of the hundreds of different apps that are available to you. Some are free, some that are cost money, but there's a lot of different options when it comes to at least starting out budgeting. The most important thing is that you start. Budgeting is a habit and a skill. It's not something that's going to come easily to you when you first start out. It takes practice of getting in the mindset of purposely knowing every time you pay somebody with cash or you swipe your credit card, you know that that money is coming from a pre-allocated bucket that you've said, yes, I can spend $200 this month on dining out, or I can spend X amount of money on groceries. And then you know if you're going to overspend in any one of those given categories, that money has to come from another bucket somewhere, or else you're going to need to pulling it from savings. And then the hard part is once you have maxed out any of those given categories and you realize, hey, I can't go and spend more than this when it comes to choosing to dine out instead of just coming home and eating some of the leftovers that you have in your fridge. That's when it's going to come into the matter of having some self-restraint and being able to prioritize what's most important. Is it better to go out and grab something from Wendy's, or is it better to save that little bit of extra money because knowing you'd have to pull from savings otherwise, and instead come home and eat some leftovers that you have, or maybe just grab a bag of cereal? Mistake number 2 here is not having an emergency fund. There's far too many people with study after study that show that they don't have enough money on hand for a $400 emergency or a $1,000 emergency. For most people, if they have some sort of financial emergency pop up, the initial action that they do is they just swipe with their credit card and make that problem that they're going to worry about later. Now, that's all fine and dandy if you're able to pay off that total balance of your credit card in full every single month. But if you're not in that situation, then you're going to have to start worrying about carrying a balance. Sure, you can make whatever the minimum payment is, say it's $20, $40, whatever your specific card has. But any leftover balance that you have that you're carrying month to month, you're going to be paying some absurdly high APR just to be able to carry that balance. You'd be paying 10%, 20%, in some cases almost 30% in interest just to carry that balance. And that's money that isn't going to be yours, but is instead going directly to the credit card company because you didn't have money to be able to cover whatever that emergency was. So what does an emergency fund look like? Typically, the various advices that you're going to see out there is you're going to want to have 3 to 6 months worth of expenses to be able to set aside and have set in savings. You're not investing it, you're keeping there as readily available cash, so that way if something comes up, you can use it without having to worry about sell or timing the market right. Where do you figure out how much you need in terms of 3 to 6 months worth of expenses? That's going to come back to budgeting. Figure out what you're spending on a monthly basis. You can take out giving, investing, savings, and that's going to be your monthly expenses. Multiply that by 3 or 6, whichever one's going to give you the most comfort level. You can have a smaller emergency fund if you have a more stable job. If you have a more risky or more seasonal job, say you're self-employed, having a larger emergency fund is probably going to be more prudent. So what happens when you do have an emergency? Let's say you need a new radiator on your car, your refrigerator goes out, you just so happen to be in the bad part of town and somebody slashes all of your tires. You're going to need to pull that money from somewhere, and by having an emergency fund in place, what would previously be a financial emergency is instead a financial inconvenience. Yes, all of those things would still suck to have happen, and you don't want them to happen. But while those things are going to be bad enough on their own, you don't want to also have the issue of needing to take out debt to be able to fix whatever went wrong. Now, mistake number 3 of not living below your means is going out and financing a car. Now, I know that nobody wants to have a crappy beater car, but it does go to living below your means. I'm not saying you should just go buy the cheapest thing that's out there, knowing you're going to have to put more money into it for repairs. But if you can get a good, safe, reliable car that's going to get you from A to B, that is ultimately all you need in terms of transportation. Going with a brand known for its reliability, like Honda or Toyota, is a good place to start. You don't need to have a Lamborghini or a Ferrari or a high-end Mercedes-Benz to get you from A to B. Remember, cars are a depreciating asset. They lose money as soon as you drive off the lot. Unless you happen to luck into some sort of collectible car that is valuable 10 or 20 years down the line, all cars are going to be losing money as soon as you buy them. So it's a matter of prioritizing how much of your discretionary income are you okay with spending on that car. If you don't make a lot of money, that means you need to be getting a car that was going to meet those basic needs, but nothing above that. Once you start making a lot more money, you get into sort of that millionaire status, you have real net wealth, then you can be looking at, hey, I have all this discretionary income and I feel comfortable I can waste $100,000 on a car. Because yes, I could have spent that on a vacation or something else, but I'd rather spend it on a car because that's something that is important to me. So going out and financing a brand new car is a huge mistake I see a lot of my peers make, or some of my previous peers had made when they just started making money. They wanted to have that status symbol, but I promise you that status symbol is not worth all that extra interest you're going to be paying and that money that could have been going towards your investments or saving up for something else. Now, 4th up on this list deals with credit cards. I like credit cards. I think they're super helpful. Being able to have them as an additional risk mitigation measure, somebody steals your credit card information, the credit card company's on the hook and not you directly. Being able to earn rewards and points, being able to multiply the value of your money by using redemption options and various benefits that credit cards have are excellent. But do not fall into the trap of thinking that the credit card and the credit limit that you have is a way of living above and beyond your means. You should be using a credit card the same exact way that you would use a debit card. A debit card doesn't let you spend any money that you don't already have, and you should view a credit card the same exact way. Don't go buy things and plan on rolling that balance from month to month. Same thing with any other dangers of financing. As soon as you have that balance and you haven't paid it off in full, that money that could have been going towards your investments or some other sort of savings is instead going directly into the pocket of the credit card company because you're paying them a lot of interest. So credit cards are useful, but you have to use them the right way. And if it's too much of a temptation for you to have a credit card with a high balance and you're going to be tempted to utilize that balance when you don't have the money to pay for it in the first place, just stick with a debit card instead. There's a lot of good debit cards that are out there that do offer a lot of the similar protections that a credit card have, and even some of them do offer the ability to earn a small percentage cash back. Yes, the rewards aren't going to be as great as a credit card, but again, the downsides are going to be a lot better because in no instance can you ever spend more than you actually have. So a debit card's never going to get you in debt, but a credit card certainly can. So figuring out where you fall on your ability to manage your own impulses is going to be really important in figuring out how a credit card fits into your financial plan or it doesn't. And the 5th mistake I want to talk about here is becoming house rich but cash poor. Once you've worked hard, and I know it's really hard to build up a large enough down payment to be able to afford your own house, but once you get to that point, it's very tempting to try and get the largest mortgage that you can potentially afford with that down payment. Houses are great and they do appreciate, but you don't want to have a giant mortgage payment in tying all of your stuff into one bucket. You're not diversifying your ability to invest. Real estate is a great way of investing and being able to make a lot of money, but you're not going to make a lot of success if all of your money is invested with one single property. You want to have a relatively modest mortgage payment so that way you can go and invest your money in other real estate purchases or invest it in the stock market or wherever you're deciding to diversify your investments into. You don't want to have all of your monthly budget tied up with that house payment because then you're just not going to have flexibility. Having a lower house payment, going with a 30-year fixed rate mortgage, and having that something that isn't the total maximum amount that you could afford, but gives you wiggle room and things come up, is going to give you a lot more flexibility to be able to respond to financial setbacks in the future and set yourself up for a better life forward. Last mistake on this list, and possibly the most potential to actually damage your finances in your future, is falling for the sunk cost fallacy. Now, what is that? This fallacy goes that after you have spent money and or time on a project, whatever that sort of project is, and you've gotten a certain way down the project, And then you realize that that project is going to spiral out of control, whether regarding a lot more time to be invested or a lot more money to be invested than you initially thought, to the point that you're going to be getting a negative return on investment. You decide, because you've already invested so much time and money in the first place, that if you bail out a project at that point, you've just wasted all that money and all that time, and instead you have to continue and see that project to completion regardless of what the final result is. As humans, just as people, we hate seeing that our hard work and our hard money and our hard time that we've lost has just gone to waste. But that's where this fallacy is most critical. Once you have already invested whatever you initially have, in most instances, it's not going to be able to be recouped regardless of what you do. And so realizing that that stuff is already gone, it shouldn't play into a factor into what your future decisions are. If you've spent a lot of time and money on whatever it is, and then you see that by continuing down that, it's just going to become more and more expensive, and whatever the end result is not going to be worth it based on what you had initially started, you're going to be much better off cutting your losses at that point, pulling your money out, taking your time and investing it somewhere else. And yes, you're realizing that whatever you have initially invested upfront is a total loss. You're not getting that back. And that sucks, and it hurts to be able to see that whatever we were invested in is not worth it. But it's much better to cut your losses and invest your time and money someplace else than to continue falling for the sunk cost fallacy and just continuing to waste your resources. Now, with the idea of what the sunk cost fallacy is, now how does it actually apply to our lives? Where I see this come most into play deals with college. If you're at the age of 20 right now, or you're in your early 20s, if you're like most people in the US, you probably already have a couple years of college underneath your belt. But you need to be very deliberate and purposeful with what the purpose of that college is. And if you're not going to get to that means, you're not getting to that end that you started out with, you might very well be better off dropping out of college and doing something else. Now, I know it's really controversial, and I don't want to tell people, hey, you should just drop out because you don't feel like it. It needs to be a very deliberate, intentional thing that you're going through and deciding, okay, this is going to get me that return on investment that I wanted. I started out to study this certain major, to get a specific degree, to help me get a specific career and job path that's going to help me make more money overall. That should be your intentionality when you go into college. It is an investment like anything else, but it's a different kind of investment because instead of investing your money in the market and being able to see those returns immediately or not, you're investing this money in yourself and using yourself as kind of a product that you're improving on to be able to sell your time to other people to be able to make more money. Now, if after I've said that, you're thinking to yourself, hey, I'm in college, I have a specific major, I know what degree I'm going to get, I know what job I'm going to be looking for after graduation, and it's going to be worth whatever time and money I'm spending right now, then that's awesome. You can feel free to skip the rest of this video. But if you went to college because you had pressure from family and friends that that's what you needed to do to succeed, if you went in without knowing what you wanted to study and you were just doing some kind of general degree plan and your thinking is, hey, I have to get a degree to be able to get a good paying job, or you're just going to college because you want to have a 4-year hiatus from the real world, you want to take advantage of that college experience, the parties, the drinking, the college football games, all that type of thing, then you need to take a step back and seriously consider, why are you in college? Now, if you're in the position where you have a full ride or you're able to pay for college in all cash, that choice is up to you. But I would still highly recommend taking a step back and deciding what is the purpose of college. Because even if you have the cash to pay for all of it and you don't have to worry about student debt, you're still investing your time, which, unlike money, is something that you can truly never get back. But this decision-making process is even more important if you are having to take out student loans to be able to finance your college degree. We see that almost half of students that start a 4-year plan never graduate in the first place. And so they're spending all of that money and they're not getting anything back out of it. And then beyond that, we are seeing students that are graduating with tens of thousands of dollars in debt on average, and some students that are graduating with hundreds of thousands of dollars of debt. Now, I realize that on the high end, a lot of those deal with very specific degree fields, specifically with medicine, where they are going to be having a much higher earning potential. And so graduating with $200,000, $300,000 of student debt may be excusable and may be something that's explainable in specific instances. But if you're going for a degree that is not going to have a high earning potential on the outside, and you are just taking those student loans, you're using them to fund a vacation, spring break, you're not really taking this class seriously, you don't really know if you actually want to graduate, but this feels like the thing that you just have to do to progress through life, you are very well probably going to be better off just to, whatever you're doing right now, is to drop out of college and take your time and money and invest it someplace else. Don't fall for the sunk cost fallacy of thinking that, hey, I've already spent 1, 2, 3 years in this degree, and I've already spent tens or hundreds of thousands of dollars. If I don't graduate, even though that graduation, that degree isn't really going to help me, if I don't push through to the end, I've just wasted this time. The time that you've already spent and the money that you've already spent cannot be recovered. So deciding whether or not investing more money and more time into your college degree is super important to being able to determine, again, it goes back to that root cause analysis. Is this helping me get a return on investment? Is my money and my time that I'm investing going to bring me fruits in the future? Or am I just trying to plant some crops in a desert and nothing is going to grow? Now, if college isn't a factor for you, the sunk cost fallacy can apply to various different areas of our life. It could apply towards starting your own business. If you're just ramming your head into a brick wall trying to start a business and you're not finding any success, and you're not changing your plan of attack to try to make it successful, you're not seeking out people that you can have as advisors and trying to figure out every potential option, and you're just trying to start a business, it's potential that you're starting a business that nobody wants. There's no need for it. And so if that is your avenue of what you're trying to do, then it's not going to be successful no matter how much time and effort you put into it. And even though it would hurt, it would suck to have to stop and try to recalibrate and go in a different direction, that is going to be the better decision, both in terms of your time and your money. And again, the sunk cost fallacy can apply to anything. It could be at a dead-end job that you're working at. It could be at a job that you're working at on a specific project that you're analyzing. Making the decision to cut your losses and reinvest someplace else is one of the hardest decisions to make. But it is the decision that is going to make you better off, even though it's going to hurt in the short term. Long-term you is going to be much more appreciative of it. The bottom line with the sunk cost fallacy is that sometimes it's just better to cut your losses and move on to something else. Now, these 6 mistakes that we've covered in the last video and this video, they're not all the possible mistakes that you can make with money. That list is truly infinite. But if you're looking for specific tips and techniques on how you can actually best maximize the money that you have and make it grow for you, make sure you check out our Finance 101 playlist. Thanks for watching, and from your first penny to your first million, we're here to help.